What's going on, gang? It's your boy Track Investing back here with another YouTube video. How y'all doing? First and foremost, as we always start every video, please make sure you press that like button. Basically, that's the form of payment that I accept for the incredible knowledge that's about to get shared on this particular YouTube channel. And honestly, even if you don't want to do that, just because you're a nice person, you can press that like button. I really appreciate it. It really helps me continue to grow the channel, and I appreciate it if you press that like button. Also, make sure you comment what you guys want to learn and all that. Make sure you guys are telling me that. And lastly, I also have a Discord going. The link is right below. Make sure that y'all are clicking that and joining the Discord so that you guys can see and operate, what kind of trades I'm taking on a daily basis. Why did I take them? If you just need some more closer guidance on a day-to-day basis for your particular model and, where I think price is going and, why I think this particular trade is likely to play out, why the ones I took did not play out, etc. And just want like a closer mentorship. There's a free Discord in the channel below. Please feel free to click that. Now, today's topic is going to be very interesting. We're talking about why does the 22 model tend to fail, right? And honestly, a lot of the concepts here that I'll be teaching can apply to any trading entry or any trader entry or any entry model. Why is your entry model likely to fail? Why are you specifically? I focus on the 22 model, and I think that this is really interesting because first of all, I want to highlight that every single thing that I'm teaching here is purely from ICT. He is a great teacher. Please go and check out his YouTube channel and watch all his videos at length. It'll really greatly support you in what I'm going to be teaching here today. And he is the true source. I'm just here to express what I've learned from that and share it with you guys for those who need maybe a little bit more help on fine tuning the information, the vast information that he has on that channel. Either way, I'm going to stop yapping now. But one of the things about the specific model that I trade, the 22 model, if you have not watched the 22 model, you don't know what it is. I have a really good video that I just posted on that. I'm sure to attach that here. But in essence, a lot of people don't like the 22 model for one reason, and I think that reason is mainly because it's very hard, or it can be hard to pick out, right? Like I said in the last video, there are some strawberries in a basket, right? Some of them look bad, some of them are not ripe yet, and some of them are bright red, and bright red, obvious that this is a really good strawberry. Now, you as a strawberry picker, it is your job to only pick the strawberries that are worth eating. That is exactly what your entry model is like, right? You're going to see multiple, inversion fair value gaps. You're going to see multiple 22 models. You're going to see multiple silver bullets. You're going to see multiple turtle soups. But which entry model and which trading strategy is actually the most, or which of these are the ones that you should actually choose, right? And that is actually how you become profitable, right? You become profitable when you learn how to select the proper entries. And so without further ado, let's get right into it. What are some concepts, or what are some rationale behind, why you think a certain 22 model or a certain trading entry would work, and why not? Why would it not work? Let's actually just talk about why would it not work. And if you have some ideas, before I give them to you, before I give you basically the answers, comment below what you think. What are some obvious things? Because I may not hit everything. So comment below, what do you think are some things that may cause you to lose your trades? I would pause the video and do that right now before you continue. I'll give you guys a second to do that. Okay. All right. So the first and foremost reason why people why people lose on their trades is because they don't understand bias. Okay. So let's put that in the paper. Ooh. Bias. Need to determine your bias. So the question is, how do I determine my bias, right? What is a bias? A bias is basically you understanding, or you having an inkling that it is more likely than not that price is going to turn to a certain area, that is going to go there, right? How do you determine those, right? How do you determine your bias? I think one of the easiest ways to really determine your bias is to look in the market. Where has liquidity been taken? Where has liquidity not been taken, right? So, you want to look at any point in time when you're looking at the chart, where is it obvious and standing out to you that price has not moved or price is likely to go to this area, right? So, one, relatively equal highs and lows. Those are very, very obvious points to where you can see price is likely to go, right? Relatively equal highs and lows. And I'm talking about intrasession. This is for scalpers. This is even for, people who are trading higher time frames. If you can identify where those relatively equal highs and lows are, then you'll be able to see where price is likely to go. Even look here, even though this is after hours, right? Time of day really matters, but you can even see that some of this stuff works even in the wrong times of day because the principle stays the same. Look at these relatively equal highs right here, right? If price has already taken out a lot of these levels right here, in order to incentivize trading and transactions to occur, they need to take price to where orders are. And orders are usually kept above these relatively equal highs and lows. Okay. Why are they kept above there? That's because people who are taught traditional support and resistance, they look at this area and they say, oh, well, it's been rejecting off of here for a little bit. It's probably going to go lower, right? We come around this key level, and each time we come around here, price goes down. So where is their stop loss? Above here, right? When that gets triggered, that enables smart money to be able to move in and move price. And so when you understand where relatively equal highs and lows are, then you can determine where price is most likely to go. For example, look here, we've taken out all of these areas down here. We've taken out all this liquidity. There's these equal highs that are right about here. This high did not take out this high, right? So after we've purged this, where is price most likely to go from there, right? Price is most likely to go and take out these equal highs. Another thing that could also help you understand that is where is price reacting from, right? That's going to help you determine your bias, right? Price is reacting from this wick right here. Look at this wick, right? Price has been respecting this wick this entire time on the 1 minute. Each time that we come back in here, price moves up, right? We came back down here, took out all these things, and now you have a convolution of factors that are pointing towards, hey, we're reacting from this wick. We broke market structure right here, right? We're trading to a fair value gap, and then now we're going to take out all these equal highs above here. So going through your time frames and understanding what is your bias likely to be. Also, higher time frames trump lower time frames. So it's important to start this analysis from a higher time frame, starting from the daily down to the 4 hour, to the 1 hour, to the 15, to the 5, to the 1 minute. Because the daily time frame will dictate where the 4 hours is going, 4 hours dictate where the 1 hour is going, 1 hour is going to dictate where the 15 minute, 15 minutes is going to dictate where the 1 minute, right? So you have to understand each of these time frames, where are the relatively equal highs and lows in each of these time frames, and then trade within that and trade with the momentum. Don't trade it. You could trade against it, but you have to be really knowing what you're doing. So understand where the higher time frames are going, okay? That's going to help you determine your bias. If you do not have the right bias, right? If you do not have the right bias, then you will likely not be able to you will likely not be able to be very profitable, right? If you're not trading within your bias, you're basically just saying every single time that I see a 22 model that I'm gonna take a lot, or I'm just gonna answer it. Every single time a 22 model comes, there's really only about a 40 to 50% chance that 22 model is actually the right one. But how do you get your accuracy rate to be somewhere around 80%? That's because you're going to only select the ones that actually stick out to you as the right 22 model. So do not trade. And I'm telling you, I've been trading for 15 months. I've been doing this 22 model. I've trading for 15 months in this 22 model. I've been studying it in and out. The single most important thing that has made me to consistently lose on the 22 model is when I am looking at price and I just want to take every 22 model I see. I need to have a certain market context. I need to have an understanding. Where do I feel like price is going to go? If you don't know where price is going to go, do not take that trade. Sit down, look at it, and then write it down. Take a snapshot of it, write it down. And at the end of the week, go back and read your log about it and then understand, okay, hey, so at this time I didn't know where price was going to go, but after the fact, I saw where price went. Here's why. Why did price go to that area? Study that over and over again, and your bias will get better and better. Here's another thing that I like to look at. Look at this wick as well, right? When you're looking at PD arrays, another thing to help you determine your bias is when you're looking at PD arrays, is it only reacting off the top half, or is it coming into the bottom half of the PD array as well? You can see that each time we came into this wick right here, right? This wick is a PD array right here. Each time we came into it, we're only really hovering in the top half, and then we're rejecting higher. It basically tells you that this is a discount level that is promoting bullish pricing, right? So unless we're able to kind of close, not wick through, but close decisively through this candle, through the CE of this wick, every single time we come back here, I'm going to be also thinking about higher prices are coming next, because that's what President has been showcasing over the past trading session. right? Understanding what PDRAs are doing and how they're informing where price is likely to go is one of the biggest cheat codes that you can also have in determining your bias, right? We see here that this has been a level where it's very likely that price is reacting off this wick, right? It's likely that price is going to react off this wick. Look at it break market structure. That is now when you get the confirmation that yes, bullish pricing is most likely about to occur now, right? I can really trust that pricing is about to occur. It retraces back into a fair value gap, goes higher, right? So determining your bias is first and foremost most important. Now what's next? Another very important thing, I guess, to understand when you're determining your bias is where is price really going? And I think like this is very important for long trending days. I actually have a very good example about this, about a trade that I took. And here, let me pull it up. Here's a trade that I took that everybody can make rookie mistakes, right? Everybody can make rookie mistakes. That's not something that is new to anyone, right? So you can always make rookie mistakes. That's okay. Even I make them, but I'm still profitable as of now. But every single time that there may be times where you miss certain things, and especially on days where price is trending. So this is when Lebanon, or I believe Israel or Iran declared that they were gonna actually retaliate against Israel for all the things that they're doing in the Middle East, right? And that news, funny enough, came out around 9:30, and price started taking. Price started taking all day, right? So on days like this, you need to be very careful, especially as a reversal trader with the 22 model. You need to understand where is price likely to go and finish off for the day before you can even trust that price is about to reverse, right? So I actually have this exact example on my charted out basis. Let me just check this real quick. All right. So here's a mistake I made, right? Coming in here and looking at price a little closer. I took a price a little closer here. So price starts tanking. It now becomes, clear to me, especially with the news coming out, that this may now turn into a long range day where price is likely to just keep going downwards. Now, as you can see here, we have the purge of liquidity right here. This wick takes out this candle's low. We now break market structure once this wick comes up and takes out this high right here. This wick took out this high, as you can see. That wick takes out that high. And we have a fair value gap. Right here, even though it's really small, we have a fair value gap right here, right? We have another one right here. So this is the classic 22 model. However, this is kind of a rotten strawberry. What are the major reasons why? One, where is price likely to go, right? Where's price likely to go? Let's think about that first, right? What is this level right here? Some of you may be seeing this. This is actually a weekly fair value gap, right? This is a weekly fair value gap that price had not come to yet. I shouldn't reasonably expect price to actually reverse yet. And this is useful information for an IFVG. This is a useful information for any trading model that you're at, right? If price has not reached that weekly BISI yet, there's no reason to be taking a trade that's going to reverse. It's likely to come in price to that level. What's another reason why that trade didn't work out, right? What day was that? This was Tuesday, right here. This is when the trade was happening, right here when it fell. Look at these equal lows over here. 1, 2. I was taking that long right about here. We had not hit these equal lows yet. So it is very likely that my trade is going to be against me, right? My trade is going to be against me. That is not something that I want to be seeing. I want to see all these important levels kind of cleared, these very obvious levels cleared before I can entertain, a reversal in the other direction. I have another PDRA right here, right? This is a 4-hour fair value gap. So let's look at that as well. Look at this BISI over here, right? 1, 2, fair value gap all the way to the right. Price is reaching all the way below these equal lows into the weekly fair value gap that has a 4-hour fair value gap nested in it, and also this low right here, right above that 4-hour value gap, 4-hour fair value gap. Also, there was SMT on the 4-hour as well with ES. As you can see, This high is higher than this high if you actually do it. It's not very obvious here, but actually if you go to the ES and you look at that particular candles, or sorry, this high right here is lower than this high. But over here, this high right here is lower than this high, right? So that's SMT with ES. Okay. So basically when you see SMT like this, price is likely to reverse in the other, price is likely to trend lower in the other direction. And so it's reasonable to assume that based on the SMT market context, based on the fact that, there's that Israel and, Iran news that just came out that day, price is likely to continue to go lower and take out some very, very key long-term objectives, right? Like these equal lows, this order pairing right here, plus the 4-hour fair value gap, right? So why would I be taking a 22 model purchase right here when price has not gotten to where it's at? That doesn't make any sense. Okay, let's look at another reason why that trade didn't work out. All right, so this is the trade right here, right? Why would the trade not work out? Well, first of all, there was 10 a.m. news right here, right? 10 a.m. news. If you don't know what you're doing, you really shouldn't be trading at 10 a.m. anyway. I still took that trade because, I can trade 10 a.m. news. I kind of understand what I'm looking for. And yes, if I get stopped out, then that's just a trade I lose. But, if price is taking liquidity and it's reasonable for price to reverse in the other direction or reacting from a PD array, then I'll take some 10 a.m. news. Price just needs to be very obvious and showcasing me what I want. To be very frank, here, price is not showing me what I wanted. And honestly, I shouldn't have taken this trade. But I'm human and I make mistakes just like everybody else. Okay. So when we're here, right, we lightly tapped into the BISI on this candle. This is when I would have answered. We likely tapped into this fair value gap on this candle, right? And actually, we closed above this 1 minute fair value gap. Price goes above it. This is valid. This is a valid entry right here. And I believe this is actually where I took it. If you excuse me, this is actually where I took that entry, right? Because sometimes if you have this fair value gap, and I'll do this, and I'll also talk about this in a separate episode. I've studied about why sometimes the fair value gaps below will not get traded back to. But if you have this inverse fair value gap right here, right, it's likely that price may not come back into these fair value gap levels. In fact, I would like to see that, because then I know that price is really strong. It's going in the other direction when you leave these gaps open, right? Just like ICT talks about. And so when I see price, wick like this, right? This to me looks more like a purge of liquidity, right? As opposed to a break in market structure even further. When price wicks like that and comes back down, then to me, that's a red flag. What I'm going to start looking for then is if price is going to start breaking down, right? So you see these, I don't want to see these. Price closes through this fair value gap. It closes through this fair value gap, right? Yes, we're finding some support here, but at the end of the day, in market context, knowing that there's way more objectives below, I would not want to see price, teetering around my entry at all. And I would definitely not want to see this sweep of liquidity. I want to see price close above this high and continue to go higher, but price is not going to do that because it has places to go lower. Okay. So that's one of the major reasons why a 22 model is not going to work. Here's another reason why a 22 model won't work. And let's look at an example from like today, right? So I believe this is around 9:30 a.m., right? What do? We went down, came back up, and now we're retracing, right? It's lunchtime. We're consolidating for a little bit over here. So let's start again. We went down, started at opening range, went up, right? We've already had two strong legs of a move, right, in the AM session. PM session is now very much likely going to be, especially if there's no targets that is very obvious in your face that price needs to get to, like we just discussed in the previous day. But on a day like today, right, price goes up, price goes down, goes back up. No more really clear objectives for price to go to. Now price consolidates in lunchtime. We come into the 1 p.m. session, and price, is sluggishly coming down, right? These areas, once price has done all this, it's already done a lot of its objectives. Price is very likely just going to just teeter around for the rest of the day, right? Price is not going to really do much. Look at this. This is terrible, right? Compared to the morning, very obvious, movements, trades you can catch. PM session, it's already done so. You should not be trading in this kind of market environment, especially when you see price just starting to chop like this. I mean, really, you should not be trading in this market environment. right? So here, the reason why and you know, like I'm saying, as I'm telling you guys, I'm also learning, right? So today I did take a trade, right? Because we took out, this is the lunch low, right? This is the 1 p.m. candle. We took out this lunch low, right? Sometimes when you take out the lunch low, especially when you have, you know, equal highs up here, places to go, right? It's been a bullish day. You can expect price to reverse in the direction, especially if we take it out right after 1 o'clock, like right after 1 o'clock. Make sure that you study that. Go check that in your back testing. You'll see what I'm talking about. Sometimes when you take it right after 1 o'clock, price can reverse in the other direction. In fact, we just had a trade like that yesterday, but we don't have to go over that right now, right? But why did this 22 model fail, right? So this low, there's a low right here. It got taken out by this particular low right here. Break in market structure, fair value gap. Why did price fail right here? That's because of the general market context. You already moved a lot in the AM, right? There's no clear objectives for me to really be chasing up and higher time frames upwards, right? There's these equal highs right here, but it's very likely that price is going to be finicky. It does not have to take out these equal highs today. It really doesn't, right? And so you want to be careful that you're trading in the environments that are most optimal for your 22 model or for your entry strategy to work the best. Now, another thing I can also tell you is that look at how strong, right? This is something that can also help you to mitigate some of your losses, even if you are about to take a loss. Look at how strong this candle goes right through this fair value gap, right? I don't want to see that. I want to see price respecting that fair value gap. I want to see it wicking into it. I don't want to see it closing that deep into it, right? You can tell that based off this, right? If you look at this fair value gap right here, price closes right through that CE, right? And it does not move away immediately. It wicks back up to the top, comes back down, closes like this. You know price is very likely to take out the low at that point, right? Like I said, you want to see price really staying in the upper portion of the PD arrays. You don't want it to be closing through the CE. It can wick through it, but it should not be closing through it. When you see it close through it, especially on the next candle, it does not move in the complete opposite. Like if it closes through it, you need to demand from the next candle that it expands away, right? If it's not expanding away and it stays like this, or it goes a little bit down further, right? Then you need to be pulling out that trade. It's very likely. And if you don't believe me now, go study in your back testing. It's very likely that it's going to reverse. Okay. So we've covered, you know, basically where is price going. We covered bias. We've covered, you know, session. We've covered like session and market context. Basically, you've seen that in the session, right? Like if we've already moved a bunch in the AM, it's very likely that the PM is going to be, you know, very lackluster. Especially if we don't have any major targets that have not been hit yet, that are very obvious and staring in your face, right? So what are some other ways, right? Another one is how long does price spend in the FVG? And I actually have a really good example for that. Well, actually, you know what, before we do that, let's do premium and discount, right? So when price has already moved up, you know, 22 model, this is a great example. The 22 model is primarily to me, is either a reversal or a continuation pattern, right? So let's think about what does that mean? 22 model is going to form a lot of times, and some of your best trades, no matter what you're trading, the turtle soup is actually a reversal pattern as well, a couple others, right? When price is in a place that, how do I best put this? When price has gotten to the objective it has gotten to, right? That's when you're likely to see the 22 model reversing into some of those into that daily range, or if price is doing a Judas swing down to a PD array and then it breaks market structure and goes higher, right? Because the real bias on a higher time frame is really going higher. That's when you're going to see a lot of these 22 models. However, when you may not see a lot of them is when when you're trading in the direction of where price has already obtained its objective. So here we can see this is the PV week high right here, right? The previous week's high, right? Price has already moved a lot from the bottom of where we were, right? Price has already moved a lot. We've achieved so many objectives. We've taken out all the LR, all the low resting liquidity right here, right? The relatively equal highs right here. You've taken out multiple highs. This is the PV week high level right here on this yellow line, right? We've already done a lot. Why would you be taking another 22 model here, right? Price is not. There's no more places for price to go, and that's why you just see price starting to consolidate off, right? Another reason is the only reason why, and also we're in a deep premium at this point. We've already moved a lot. That's basically the point I'm trying to say. We're in a deep premium. We've already hit all the targets. It's already very likely that price is not going to be in your direction because price was at a premium, right? A lot of the reversals are best when you're getting it at the very lows of of where price has just gone. Or here, you should be looking at shorts, right? We're in a deep premium. Price needs to retrace back into all of this price action that has just come up here. Otherwise, it's not offering fair value, right? It needs to offer fair value again, and it needs to go back to equilibrium. When it's up here, you should not be really looking to take any more buys, especially when it's already hit a lot of the levels that you're looking for. The only reason why you could still take a trade in a premium, like, the only reason why you could still buy, let's say when it's in a premium, is because price has not gotten to where it is, where it needed to have gotten yet, right? So over here, even though we're still in a premium, we still have this weekly high, this preview week high. It's just obvious. It's staring me in the face. It's like, if we're already that close, it's very likely price is going to get there, right? So maybe that's the only reason why you would be taking a 22 model buy and riding it all the way up here. But once it's gotten there, you're already in a deep premium, my friend, you need to go and close the charts, and it's done for the session. You're done. You already hit all the objectives. We're done for the session. Okay? All right. Wait for the next session or wait for the next day. All right. So understanding, discount premium, right? If you're purchasing 22 models, at a discount, or if you're shorting them at a premium, you're already putting the odds in your favor a lot more. And we're in the business of probability trading, making sure that we are refining the odds of our trades to the most that we can possible, right? And I think the next thing that I want to touch on, and this should be the last part, is how long we're spending inside the 22 model. And I have a pretty good example on this one as well. I want to pull it up 1 second. Well, maybe a little hard for you guys to see this one, but just bear with me for a second. When price is entering your 22 model and entering the fair value gap, count how many candlesticks are usually in there, and then you'll figure out, count how many candlesticks are, it took for price to start moving away, right? You don't want to see your fair value gap for your 22 model really being interacted with more than 5 candles. I would say it's max. 1, 2, 3, 4, 5, 6, and this is 6th candle. Look at that. We just moved down low. 7 low, right? These aggressive candles lower, especially after it being the 6th candle or interacting this fair value gap, then that the probability of this being a profitable trade is very, very low, right? You should just pull out early, right? You don't have to take the full loss. You can pull out early when it's becoming obvious to you that price is going to go in your stop loss. In the beginning, you're not going to know these things, so let it hit your stop loss. But after, make sure, because your stop loss are there for a reason. If you are not confident that price is going to hit your stop loss, then do not pull out. Stay in there, take the loss. You will learn, right? You have to learn the hard way. If you're not taking that severe pain, then it's not going to motivate you to sit down and really look about what happened, what went wrong, right? The stop loss is there to protect you, right? But when you get to a certain stage and you understand that it's very likely that price is going to hit my stop loss, you can actually pull out before then, because then that way you are keeping more of your gains when you lose, right? If you're losing less, and then you're able to keep the full amount. So when you hit your take profit and it hits your full 1 to 3 R, right? You can minimize the actual losses you're taking, so that when you do take profits, when you do take wins, right, you're not eating into that equity as much, right? So that's why it's really important to be able to refine the losses that you're taking, right? So if you're spending a lot of time in the fair value gap, you should probably just take off half the trade and then watch what happens next. If price breaks market structure and it gives you another entry, then you can re-enter back with a couple of contracts. But if that is not presenting itself and you see it's very highly likely for price to not go in your direction, then that's not a reason for you to be interacting at all. I think another reason, right? Sorry for confusion here. Right. So another reason why price, right? Another reason why price will not do what you want it to do, right? Another reason why price you will lose, right? And I hope you guys have been taking notes, because I've given you guys so many gems. Another reason why price will not go in your favor and why you may lose is because there's not immediate higher time frame alignment. What does that mean? 15-minute, 5-minute, right? Look at what those candlesticks are doing every single day. Make sure you're logging not just what the 1 minute is doing, not just what the 5 minute is doing. Log exactly what happens on the 1 hour. Well, log what happens on the 15-minute. You will begin to notice that a lot of those movements will actually trump or dictate what is likely to happen on the 1 minute, right? So you need to be able to understand, where is price what is price doing on these higher time frames, and is there an immediate alignment with that? For example, a lot of times you can take a 22 model like this, it'll look good, but on a higher time frame, there's a 15-minute fair value gap right above here. It's like a civvy, right? And price reacts from it, and then it just like automatically tanks in the opposite direction, right? You want to see price sliding through higher time frame higher time frame levels. You don't want to see it, respecting it and then reversing, aggressively in the other direction, right? And trading through the CEs or the consequent encroachments of of fair value gaps that are below you at a discount, right? You want to see price sliding through those levels or consolidating in it and then sliding through it, right? You need to be watching price very carefully, right? If price on the 15-minute, let's say it touched the fair value gap, right? On the 1 minute, it still looks good, but on the 15-minute, it touched the fair value gap and then it closes by, it wicking into that and then going lower, then I know that on the 15-minute, after you wick into a fair value gap, think about what happens on a 1 minute. When you wick into a fair value gap, like even like right here, I wicked into it right here, it's very likely that price is going to keep going higher, right? That same thing on the 15-minute, right? If there's a 15-minute fair value gap in the way, and on the 15-minute time frame I see that we just wicked into it, then on the 1 minute I'm going to be expecting that that's going to follow suit, and then the 1 minute it's actually going to start getting bearish as well, right? But on the 15-minute, let's say we close through the CE of that fair value gap, then I know I can trust on the 1 minute that price is likely to continue to go in that in the upwards direction. So you have to bake in all of these different factors. Study them one by one, focus on them one by one, and master each of them one by one, and then compile them all together so that you can really optimize your win to loss ratio. All right. So anyway, this has been another episode with your boy, Chike Investing. Let me know what you guys want to learn next. Make sure you join that Discord so we can talk about these kind of things every day. And until next time.